Timing the market is an investment strategy where investors buy and sell stocks based on expected price fluctuations. If investors can correctly guess when the market will go up and down, they can make corresponding investments to turn that market move into profit. It's usually based on gut feeling and hope rather than careful analysis. But even when it's based on analysis, it's an elusive concept. You can get it right sometimes, but the odds of getting it right in the long run are vanishingly small. In my experience, what happens is that a person will make a prediction based on gut feeling. For example, the market will continue to decline because many merchants are going out of business. If it turns out to be true, you reinforce your belief that you have a special talent to predict the market, and it will appear inevitable in retrospect. If the prediction turns out to fail, most people conveniently forget. When they look back at their predictions, looking for successes, they'll experience confirmation bias that gives them an unearned sense of confidence in their abilities. Everyone is vulnerable to this bias, even you and I, and even when we're sure we're not. In this example, the market actually recovered fast, and the predominant theory is that the merchants who are going out of business are small contributors to the overall economy. At the same time, you should realize that the stock market is not the economy. Even the people I've seen who predicted a recovery of the market while merchants are going out of business and people are losing their jobs didn't expect it to be this fast. During the recent US presidential elections of 2020, I saw the same behavior. Some friends were predicting that regardless of the outcome, the week of the election would be disruptive to the world market since the US is such a big part of it, and we would experience a decline. They delayed their investments in preparation for this. We saw the opposite of what they predicted. The market went up even with all the public unrest. Consider as well that people have been saying a market decline is imminent for years, and what we got was the biggest bull period ever. As the legendary investor Peter Lynch said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. The bottom line is, market timing is incredibly hard, and if you think you can pull it off, you're probably wrong. It's overall not the strategy we should be using. As Javier Estrada showed in his paper, Black Swans and Market Timing, for the period of 1900 to 2006, missing the 10 best days could lead to a portfolio 50% less valuable. And missing the 10 worst days could lead to a portfolio 150% more valuable. Notice it's nearly impossible to hit that window of time. It's too short given the total time of the study, and you don't know when it happens. It's a needle in a haystack. It's almost impossible to predict the behavior of the market. Even if you're successful, sometimes you're more likely to fail in the long run. Some investors try to predict the market based on the emotional investing behavior of others, like how many average investors tend to buy when a stock price is high and overreacting to bad news. If you search, you'll find instances of this where it appears to work, and instances of this where it fails. I tend to put more weight on the cautionary tales around this because the risk is so big and the benefits are questionable. Even Warren Buffett doesn't think it's a good idea to time the market. He considers it a distraction. Try to avoid the human tendency to speculate. Distrust it. It usually doesn't work. It's also stressful and time-consuming. Most people will do much better with a good passive investment strategy where they're not looking at the stock market every day. Usually, a superior strategy is to continuously buy and hold diversified assets for a long period of time. Think more than a decade. Investment is going to be risky regardless, but this strategy reduces the risk. If you're still not convinced, I linked an article in the description from Nick Maguli that dives deeper in the topic. Remember that time in the market beats timing the market, and that most of us tend to have an irrational tendency to go for the bad strategy. One of the most important skills of a good investor is to avoid bad strategies, such as market timing. And think how great that is. To do a good job, you have to do less. Less speculating, less following the market on a day-to-day, less obsessive analysis, and less betting.